All right, let's talk about Intuitive Surgical. You've probably heard of them. They're the undisputed king of robotic surgery. For years, they've absolutely dominated the market. But here's the real question, especially if you're an investor. What is all that dominance really worth?
17 million. Let that number sink in for a second. That's how many surgeries have been done using Intuitive's Da Vinci robots all over the world. I mean, it's just a mind-blowing figure, and it really shows you the sheer scale of their empire. We're not just talking about a market leader here. For something like 2 decades, they were the market. So how'd they do it? Well, to get that, you really have to dig into the genius of their business model.
So, see, Intuitive didn't just go out and build a cool robot. No, they built an entire kingdom, complete with this massive, almost unbreakable economic fortress around it. And the engine that powers this whole empire? It's a classic business strategy, but they just executed it, well, perfectly.
You've probably heard of it. It's the razor and blades model. So what's the razor? For Intuitive, that's the Da Vinci surgical system itself. You know, the big, complex, multi-million-dollar robot that a hospital buys. But that's not where the real money is. Oh no. The real money is in the blades. These are the proprietary, super-engineered instruments and tools that get used up after a few procedures. And the key thing is, hospitals have to buy them from Intuitive for every single surgery.
And when you see the numbers, the power of this model is just, wow. A massive 84% of their revenue is recurring. It's coming from those high-margin blades and service contracts. Now, if you're an investor, this is basically the holy grail. We're talking stable, predictable cash flow that isn't really tied to whether a hospital has a big budget for new equipment this year. It's way more like a subscription than a one-off sale.
And this whole thing kicks off a powerful, self-feeding cycle, what you might call a flywheel. So step 1, a hospital buys a Da Vinci system. Okay, now what? Well, to use it, they have to train their surgeons on it, right? And that creates this deep loyalty and expertise. Then, as those surgeons do more and more procedures, the hospital has to buy more and more of those high-margin blades. And eventually, demand gets so high, the hospital needs to buy another system. And boom, the whole cycle just starts right over again.
It's this flywheel that has built the walls of their fortress. This is what we investors call a competitive moat, and it is deep. I mean, think about it. Over 10,000 systems out there globally, an army of more than 76,000 surgeons trained on this specific platform, and this treasure trove of data from those 17 million procedures. So the cost for a hospital to switch to a competitor, it's not just buying a new machine. It's the absolutely massive, almost impossible task of retraining your entire surgical staff. It's just impractical.
But here's the thing. After basically 2 decades of peace and quiet, operating in a virtual monopoly, well, the party's over. Powerful barbarians are at the gate. We're talking about some of the biggest, richest medical device companies in the entire world. And they are finally here, ready to challenge the king for the throne. The robot wars have officially begun.
Okay, so this fight isn't just about who has the better robot. It's not just hardware versus hardware. It's a battle of entire ecosystems. On one side, you've got Intuitive's deeply entrenched fortress, all that training, all that data, the way it fits into a hospital's workflow. And on the other side, you've got these huge challengers coming in with a pure hardware attack. You've got Medtronic's Hugo, which is designed to be more modular and flexible. And then there's Johnson & Johnson's Ottava. This thing looks futuristic, with the arms integrated right into the table to save space. They're coming in with some cool, different tech for sure. But here's the billion-dollar question. Is that enough? Can a cool new piece of hardware by itself break down the walls of that massive ecosystem?
But don't think for a second the king is just sitting on the throne watching this happen. Nope. Intuitive is aggressively fortifying its kingdom, preparing its defenses for this next chapter with a huge upgrade to its main platform.
And this is their main counterattack, the brand new Da Vinci 5 system. And this move is it's strategically brilliant, because this isn't just a slightly better version of the old one. We're talking about game-changing features like force feedback, which for the first time lets surgeons actually feel the tissue they're working on through the robot. And get this, it has 10,000 times the computing power of the old one. This is Intuitive changing the rules of the game. They're shifting the entire battle away from just hardware and mechanics and over to data and information. And guess what? That's a fight where their 17 million procedures give them an absolutely massive head start. And check this out. While they're defending their core business, they are also on the attack, aggressively expanding the empire. I mean, their main systems are still growing at a really healthy 17% a year, which is great, but look at the growth in their newer, more specialized platforms. The Ion system, which is for lung biopsies, is growing at a crazy 52%. And the Da Vinci SP, for single-port surgery, that's growing at 38%. So they're not just playing defense, they're out there conquering brand new territories. Okay, so this all brings us to the core dilemma for anyone looking at this stock as an investment. The company's quality? It's undeniable. Its position in the market? Totally formidable. The growth? It's clearly still strong. But, and this is a big but, what's the price of admission? What do you have to pay to own a piece of this kingdom?
And honestly, this table right here kind of says it all. Just look, Intuitive Surgical is trading at a forward PE ratio of about 54. Now compare that to its rivals, Medtronic and J&J. They're both trading around 17 times earnings. What this tells you is that the market isn't pricing Intuitive like a regular medical device company at all. It's pricing it like a premium, high-growth tech company, a SaaS company. And it's all because of that incredible 84% recurring revenue stream we talked about. The market is paying a huge premium for that predictability.
Of course, when you pay a premium price like that, you're taking on some pretty significant risks. For one, competition could finally start to chip away at those juicy margins. Then there's the whole GLP-1 weight loss drug phenomenon, Ozempic and the like, which could be a long-term headwind if it reduces the need for certain types of surgery. And let's be real, the law of large numbers is undefeated. Growth is eventually going to slow down. But maybe the biggest risk of all is just the valuation itself. A stock that's priced for perfection is incredibly vulnerable to any stumble, any slight miss in execution.
So there you have it. That's the story of Intuitive Surgical, seen through the eyes of an investor. You've got this absolutely incredible company with a powerful, deeply entrenched business model. But it's now facing its first real competitive challenge, all while its stock is trading at an incredible price. And that leaves us with the ultimate multi-billion-dollar question, doesn't it? Is that moat really deep enough to justify paying this much for a key to the kingdom?